As you journey through life, having financial goals in place can help you achieve financial security and build a brighter future. Whether you are just starting out or well into your career, setting financial goals is essential to effectively manage your money and make informed financial decisions. Welcome to Money Mindset, where we provide educational resources on money, personal finance, and investing. In this video, we will be talking about 5 financial goals you should consider setting for yourself. If you're serious about enhancing your financial future, make sure to hit the subscribe button and like this video if it was helpful to you. Emergency Fund. Having an emergency fund is not just a financial goal, but a crucial aspect of financial planning. Life is full of uncertainties, and unexpected expenses can quickly derail your financial stability. Whether it's an unforeseen medical emergency, unexpected car repairs, or a sudden job loss, having an emergency fund can provide you with a safety net during times of crisis. The general rule of thumb is to aim to save 3 to 6 months' worth of living expenses in an easily accessible savings account. This amount may vary depending on your individual circumstances, such as your job stability, monthly expenses, and risk tolerance. If you have dependents or a less stable job, you may want to aim for a larger emergency fund to ensure you have enough cushion to cover your expenses in case of unexpected events. Having an emergency fund can prevent you from going into debt when unexpected expenses arise. Instead of relying on credit cards or loans, you can use your emergency fund to cover the expenses, avoiding the burden of debt and its associated interest payments. It also provides you with financial peace of mind, knowing that you have a financial safety net to fall back on during challenging times. When building your emergency fund, make sure to choose an easily accessible savings account, such as a high-yield savings account or a money market account, that allows you to withdraw funds quickly without incurring any penalties. Keep the emergency fund separate from your everyday spending account to resist the temptation to dip into it for non-emergency expenses. Building an emergency fund may require discipline and commitment to regular savings, but it is a crucial financial goal that provides you with a sense of financial security. Start early, set a realistic savings target, and consistently contribute to your emergency fund until you reach your goal. Once you have built an adequate emergency fund, you can move on to other financial goals with the peace of mind that you have a financial safety net in place to protect you from unexpected financial setbacks. Retirement savings. Planning for retirement is a crucial financial goal that requires careful consideration and early action. While retirement may seem distant, starting to save as early as possible can significantly impact your financial security in your golden years. The power of compound interest can work wonders over time, and the earlier you begin, the more time your money has to grow. One of the most common ways to save for retirement is through retirement accounts such as a 401k or an IRA, individual retirement account. These accounts offer tax advantages and allow your investments to grow on a tax-deferred or tax-free basis, depending on the type of account. Contributing regularly to these accounts can help you build a substantial retirement nest egg. It's important to aim to increase your retirement contributions over time. As your income grows or your financial situation improves, consider allocating more towards your retirement savings. Many employers also offer matching contributions to 401k accounts, so take advantage of this opportunity to maximize your retirement savings. Be mindful of the annual contribution limits set by the IRS for these accounts and strive to maximize your contributions within those limits to maximize your retirement savings potential. Seeking guidance from a financial advisor can be beneficial in determining the right retirement savings strategy that aligns with your long-term financial goals. A financial advisor can help you assess your retirement needs, risk tolerance, and investment options to create a personalized plan tailored to your unique circumstances. They can also assist in adjusting your retirement savings strategy as your financial situation evolves or as you approach retirement age. Remember that saving for retirement is a marathon, not a sprint. It requires consistent contributions, careful investment choices, and long-term planning. Starting early and taking advantage of the power of compound interest can significantly impact the size of your retirement nest egg. So, don't delay, prioritize your retirement savings as a key financial goal, and take steps to ensure a comfortable retirement future. Debt repayment. Debt repayment is a crucial financial goal that should not be overlooked. High-interest debts, such as credit card debt or student loans, can easily snowball and impede your financial progress. Creating a systematic plan to pay off your debts is essential to regain control of your finances and achieve your other financial goals. Start by assessing your debts and prioritizing them based on their interest rates. Typically, debts with the highest interest rates, such as credit card debt or payday loans, should be paid off first. These debts can quickly accumulate due to compounding interest, making it harder to get rid of them in the long run. Creating a budget and allocating as much extra money as possible towards these high-interest debts can help you pay them off more quickly. Once you have paid off one debt, use the extra money that is now available to pay off the next one. This strategy, known as the snowball or avalanche method, allows you to build momentum and tackle your debts one by one until you are debt-free. Alternatively, you can also consider consolidating your debts into a single loan with a lower interest rate to streamline your payments and potentially save on interest expenses. Investment portfolio. Planning for retirement is a crucial financial goal that requires careful consideration and early action. While retirement may seem distant, starting to save as early as possible can significantly impact your financial security in your golden years. The power of compound interest can work wonders over time, and the earlier you begin, the more time your money has to grow. One of the most common ways to save for retirement is through retirement accounts such as a 401k or an IRA, individual retirement account. These accounts offer tax advantages and allow your investments to grow on a tax-deferred or tax-free basis, depending on the type of account. Contributing regularly to these accounts can help you build a substantial retirement nest egg. It's important to aim to increase your retirement contributions over time. As your income grows or your financial situation improves, consider allocating more towards your retirement savings. Many employers also offer matching contributions to 401k accounts, so take advantage of this opportunity to maximize your retirement savings. Be mindful of the annual contribution limits set by the IRS for these accounts and strive to maximize your contributions within those limits to maximize your retirement savings potential. Short-term goals. Setting short-term financial goals alongside long-term ones is crucial for maintaining motivation and making tangible progress in your financial journey. Short-term goals are typically achievable within a shorter time frame and can help you stay focused and motivated along the way. Short-term financial goals can vary depending on your personal circumstances and aspirations. They could include saving for a down payment on a house, funding a dream vacation, purchasing a car, or paying off a credit card balance. The key is to set specific and measurable goals that are realistic and attainable within a relatively short time frame. Creating a timeline for your short-term goals can help you stay on track and monitor your progress. Break down your goals into smaller, manageable steps with clear deadlines. For example, if you're saving for a down payment on a house, you could set a goal to save a certain amount each month and aim to reach your target within a year or two. Having a timeline in place can help you stay accountable and motivated to achieve your goals. Remember, financial goals are unique to each person and should be tailored to your individual circumstances and aspirations. Regularly review and reassess your financial goals as your circumstances change and update your plan accordingly. With careful planning, discipline, and perseverance, you can achieve your financial goals and build a solid foundation for your future financial success.